So you're basically cutting across the volatility and you're buying it at a high and a low and a high and a low. But over time, you know that the asset's going to do well, and therefore the strategy plays out.
Welcome everyone to the third episode of Think Out Louder. Today we're going to talk about dollar cost averaging, the philosophy behind it, why it works, and when it doesn't work. So stick around till the end. You might learn something, eh? It might apply for retail investors. It might be good for long-term growth. We might also be talking about a way of getting rich really, really quickly. So stick around and let's get straight into it. Who's going first? I think I see Blake very interested in this topic. So Blake, what's your go with dollar cost averaging?
So dollar cost averaging is an investing principle which is recommended as a new investor. In simple terms, it's investing small amounts of money in fixed periods of time. So all of us, knowingly and unknowingly, tend to use this investing principle. If you have a superannuation account, or in America it's called 401, what happens is from your salary, a small amount, around 10 to 15%, goes into an investment portfolio, which could be a diversified set of stocks, it's real estate or whatever. But by the time you finish your career, you have a lump sum waiting for you, which has been invested for you bit by bit in fixed periods.
Right, and so hopefully that would have grown to a very huge value by the end of your career. So Oliver, what's your thought on all of this stuff?
Yeah, so the dollar cost averaging philosophy, whatever you guys said makes sense. But for me, I'll tell you what it means to me, right? So for me, it is when you have a fair bit of certainty of a stock or an asset class performing performing better over time, but you don't want to put all your money into it at once. First of all, as a retail investor, you don't have that much money to put all at once. So it is to break it up into chunks and put it over a period of time, especially for an asset class that is volatile. So you're basically cutting across the volatility and you're buying it at a high and a low and a high and a low. But over time, you know that the asset's going to do well, and therefore the strategy plays out. It's a sort of lower risk, kind of guaranteed way, depending on the asset, to make money and save in the long term. That's what I think about dollar cost averaging.
And I agree with the aspect of certainty and also the aspect that it is quite low risk. For me, whenever I think of dollar cost averaging, right, the one thing that comes to my mind instantly is just safety. It's providing that safety, much needed safety for retail investors. Because this is not a casino. As much as people would like to tell you, guys, investing is not a casino, right? You could treat it like a casino, but highly suggested not to. And that is where things like dollar cost averaging and other philosophies, there are plenty of philosophies, you've got to find the right fit for you. Dollar cost averaging for me, so it's safety. Blake, do you have any examples or something you want to share from your personal experience with dollar cost averaging?
Dollar cost averaging is not something which I use to be personally. And as you said, it all depends on your investing mindset. I do like taking risks. You gotta take risks to make money. And I'm the person who leans towards a bit of a gambling habit, but being very mindful on the risk, trying to manage that risk and trying to get some gain out of it. I do use some aspect of dollar cost averaging, which I will speak a bit later. But I think I'll pass it on to Oliver. He might be the best person to speak about this.
Thanks, Blake. Oliver, Do you have a personal example as well from your story about dollar cost of investing? Eh?
Yeah, I do actually, and it's worked quite decently or quite well in 2021 especially. So I decided to get into crypto, and I decided to have a position and grow my position in Bitcoin. And obviously in crypto, it's the most volatile asset, right? So it jumps 5%, falls 20%. So what I decided to do, and it was mostly out of a whim, I didn't really believe in a specific philosophy or specific style. I just decided to put $100 a week, 100 Australian dollars a week into Bitcoin, and just test it if this strategy works, because we know that Bitcoin over a long period of time has done really, really well. And I can attest to it that it has done well. Like, I mean, when I started off at like when it was 20K to now, which is it's almost 90K, I was able to buy at multiple levels and sort of average out my price over time.
What a beautiful example, Oliver. That's exactly what we all aim for, eh? A high growth asset, and we dollar cost our way into it from the beginning till the end. From my own personal example, I want to choose Salesforce. Salesforce, most people might consider is already a massive behemoth in its sector, but it still has performed like really well, like a growth stock. I started with CRM after researching the company, and then I liked the way the CEO treats his employees. So if you look at the numbers as well, it was on a path to growth because of the acquisition of Slack, etc. I started the beginning of 2021 and kept buying 6 or 7 parcels, and it worked really well. If you look at the graph for CRM, you can see here, if you dollar cost your average your way all the way up till the end of 2021, you've made money. So I think, yeah, it's a great philosophy. But then dollar cost averaging may not always be the best strategy. So Blake, can you think of anything which is like negative about this strategy, and something that you don't like?
Well, there's a few things I can which comes to my mind. One is as an experienced investor, dollar cost averaging is a bit lazy. You pick one stock and you just keep putting money into it without thinking about it, because you are committing to put it in a fixed period of time. So it does tend to give you a narrow focus. You're not looking at any of the stocks in this time period, and the stock you pick may not be as green as you first started out. So in terms of that's one aspect which I think I don't like, and that is where I would say dollar cost averaging works for a value stock or an ETF. I don't agree on volatile assets like crypto or a Tesla stock or an ETF, NTF, whatever that shit is.
An ETF and an NFT.
NFT, yeah.
And you don't like either of them, eh?
Like, fair. I can't fathom it. I'm a bit conservative in that outlook.
Mm-hmm.
I'd like to see how it goes, and then maybe I'll dip in a little later. But right now, I'll watch the space from really far away.
Fair enough. I think there are great points actually to not be in this sort of like volatile asset and trying to make money by dollar cost averaging. Maybe it doesn't work. You never know. Oliver, what are your thoughts?
No, it makes sense. So what you said, right? Dollar cost averaging doesn't make sense if you're an active investor. And that is true, because dollar cost averaging is a more passive style of investing. So for majority of us who cannot devote all of our time or a significant chunk of our time into investing, this is where dollar cost averaging helps, because you're taking out all the sort of attention that you have to give by forcing yourself to be disciplined and to put it in a fixed amount into a sort of relatively safe asset class. And you don't have to be an active investor. So that I definitely agree that it's a more passive style.
Do you think that it's because you decouple the psychology of a person in a market from the actual investing?
100%.
Do you think that plays a big role?
100%. And if dollar cost averaging, when done right, it is to not be too fancy with dollar cost averaging. What I mean by that is, what does it mean? It mean to dollar cost average. When you go into the specifics, right? It's about putting a fixed amount without you trying to control when you're going to put that amount in. So you don't want to like say, today when the market's going up, I want to put in the money regularly. But then when the market falls down, I'll be like, no, maybe I should wait another month. I'll start dollar cost averaging 2 months from now. So that's when you're breaking the sort of beauty of dollar cost averaging.
Basically what you're saying is you have a start and a stop, and you pick your intervals and you go at it no matter what the market does.
You have to automate
it.
I think it brings to mind one other common investment which everyone does throughout their lifetime. Think about it. Your house loan. Your house loan is a dollar cost averaging principle as well. You commit to it for fixed periods of time. No matter what the real estate market does, you will keep investing into the asset that you have committed to. So there are instances where dollar cost averaging is the right thing to do, but it depends on your investing mindset and what your financial strategies and goals are.
And yeah, great points. But one thing that comes to mind is if someone wants to get really really rich really really quickly, dollar cost averaging is not for you. I'm looking at all you gamblers, all you people, all you so-called RETARDS. Can we use that? Can we use that term from Wall Street bets? Just throwing all your money. Dollar cost averaging is not for you. But you know what? An interesting thing is the great economists of our generation and previous, like Adam Smith. You go into all of the other, like Milton Friedman. These people were highly leveraged in the market and freaking made millions, but one crash and they were broke again. So I mean, you want to live a millionaire lifestyle, it's possible. You just have to leverage yourself, and we've seen that time and again. But yeah, from my perspective, I think dollar cost averaging is not for the gamblers. What are your thoughts?
Yep, that's true. So for me, the reason I don't dollar cost average is I have a superannuation, and maybe in a couple of years, I will get a house loan. So that's two investments and assets that I'll start dollar cost averaging. The third is where I can be a little more ambitious. I can put in my research and take my time and find the right moment and use some of the principles of dollar cost averaging. This is what I was saying earlier while we were talking. Dollar cost averaging, in its principle, you can take out the idea and forget the fixed time period. Instead of putting money in fixed time periods, you can start investing money in irregular periods. So as you come across money and then
buying the dip.
Buy the dip is one way of doing it. Sure, actually, buy the dip is something you should always be ready for, because if you have always keep some money with you to invest, and then when you see the stock market crash, it's a good opportunity to assess and jump right in.
I completely.
I feel like we've
agree.
got a boomer. We've got a boomer on the podcast. Let's hear from let's hear from a millennial and see what he thinks. I'm being generous when I say millennial, but okay. Go for it, Oliver.
Yeah. So it's definitely not, to your previous point, it's definitely not for the gamblers and for dollar cost averaging is not for traders. It's not for active investors. It's not for people who want to wait for companies to get to, like, value investors who want to wait for companies to get to of value and then put in a huge chunk of money. Yeah, it's for essentially passive investors who want to de-risk themselves, who want to put in what if you look at the best example of dollar cost averaging that has done really well over time, it's broader market indexes, right? So putting in money paycheck to paycheck, every paycheck, putting in X amount of money into like the NASDAQ or into like the broader market index.
S&P 500.
S&P 500.
Any of
So
those big.
over the course of like the last 10 years, 15 years, 20 years, to about 100 years, it has done insane amount of money. It has gained insane. So that would have been like an ideal scenario to dollar cost average into, right? So yeah, that's what I think about where it makes sense.
Okay. I think we have a emerging trend here that dollar cost averaging is for the safe, passive investor types. I'll throw a spanner in the woodworks for all you guys here, and I'll ask a question which maybe will seem out of place, but I think it's intriguing. Would you guys dollar cost averaging starting today into Tesla? Blake?
Tesla is a stock which I'm not too fond of. I believe their stock value is already overpriced. If Tesla, if it was Tesla 5 years ago, possibly, but if I have to commit it for 10 years time, I don't know what Tesla's future is for 10 years from now, and I have no faith that Tesla is going to be as big as it promises to be. So for me, no, I would pick a different stock, but not Tesla.
So sad. Why would you not trust Elon Musk? The guy's like promises every single day, eh?
There's a gazillion EV companies which come and go. Tesla is the one which has stayed around the most, but just the competition in the market can really take the value out of the industry for individual corporations. That's my biggest wariness
issue problem
Tesla.
With Tesla. Well,
Yeah.
you're not alone, man. They've been, you know the saying, never shot Tesla. I don't know. What do you think?
I have a lot of respect for Elon Musk, but I'll let Oliver speak.
Yeah, so there's two reasons why I wouldn't dollar cost average into Tesla. So number one, the stock price is insanely overvalued, right? So I cannot say for certainty whether the company would be a great investment 10 years from now, just because the stock price is absurdly high. So that's one reason why I wouldn't start an investment even dollar cost averaging. Second reason is, even though Tesla is firing on all cylinders right now, I can't say for certain that 10 years from now the company is going to do equally well or would be growing equally well as it is now. However, if Tesla stock falls drastically, I would rather not dollar cost average. I would rather go lump sum.
Go all in.
Go all in. Not all in, but go most in.
Go bankrupt.
Go most in. Just because that to me is a better opportunity to play Tesla over a long period of time as opposed to dollar cost averaging.
So you won't go all in, but most in. I'm not going to let this opportunity go by. That's what she said. For me, I would most definitely start dollar cost averaging Tesla, because I think Tesla is a very, very misunderstood stock. Value investors consider it an EV company, just an automobile manufacturer, and compare it to Toyota and all of these other companies which are on their way to failure. If you look at the most common and the most famous thing I read online about Tesla is, Tesla is worth more than every single other car manufacturer in the world combined. I mean, when you take failing companies of their value in negative, if you add all of the negatives together, it's a huge negative. So all the more reason for Tesla to be bigger than all of these combined. I feel Tesla is not just an automobile company though. It's a robotic company. It's a data company. It's an AI company. Everything that it's a connected world company. And just look at the philosophies and the values of Elon Musk. The man wants to go and die on Mars. I want him to do that, not die, but if he wants to go and
Well,
But he'll do it
I'll
with,
pass away on Mars,
I'll buy you
Yeah.
some Dogecoins for your birthday. You just reminded me.
well, how do you know I already don't own Dogecoin? Doge boy.
you don't own enough.
Well,
I don't
know enough,
own
mate.
enough of it. Yeah,
Yeah.
but now
if you
I think
if you own enough Dogecoins, Elon Musk will will give you a seat in his rocket, and you can go together to Mars.
I wish. I wouldn't mind. Living or passing away on another planet. You could be the pioneers of a different species on another planet, man.
Yeah, and
Or
you'll
not different species, but a start of another civilization.
and you'll do that on a SpaceX Falcon X, not on a Tesla.
And how about this? Throughout the journey from here to Mars, I will dollar cost average my way into Dogecoin so that when I reach Mars, I am fucking rich. All right.
Yeah.
I think we've got like really good viewpoints on here about dollar cost averaging, the positives, negatives, some crazy stuff. But any last views before we close this session? This nice and simple session about dollar cost averaging.
Dollar cost averaging is a really good principle to start investing. Use it for a lot of other financial decisions that you might want to undertake for your personal life. But if you want to be a serious investor, take some risk, save some money, do some research, and put on your casino hat. if there ever was a saying of that.
Well, there now is. Oliver, what are your thoughts?
My thought is, I just wanted to add like what one should not think to do with dollar cost averaging is look at a company that is sort of declining in value and think I'm going to average down and I'm going to dollar cost average down to a best price, a better price, because the stock is like crashing. Like for example, Peloton, that the stock has fallen like I don't know, 60%.
Brick. I'll give you a good one. It has fallen like a brick.
Fallen like a brick, fallen like a knife, fallen like an axe on your foot. So you don't want to be like, oh, I'm going to average down. So that's not dollar cost averaging, because that is actually what you're not supposed to be doing. You're not supposed to be catching a falling knife, because it's not going to get pretty, because you'll always get a better price until it goes to zero and then you have no price. So yeah.
The thing about catching a falling knife is if you get it right, you have something to speak about. So I think in some situations where you do trust in the value of the company or to innovate and to get out of a slump, and if you think that the slump is because of some bad news or something, a rumor maybe, then I think you should go and try and catch that knife, man. That's how you get rich.
That's how you get stabbed as well.
You can cut yourself. Nobody said this was a children's game. Children don't try this.
If someone throws a knife, you can try and catch it with your hands, or it could fall into your eye. But if you catch it in your hands, you're a legend. You're a legend. You're the upper hand now. You can go stabby everyone.
Okay, let's end on that. We go. Children, do not try whatever Blake says on this podcast, because some of his ideas are out of this world and only for seasoned personnel within the stock market. And children, please do everything Oliver tells you. He's the nicest man you'll ever meet. He will make money for you. We've got some great wins in our playbook. I think we'll be talking about this in upcoming episodes. So we'd like to know what you guys think. What do you think? Okay, I'll give a question to the audience. Would you guys dollar cost average in Tesla right now, middle of November 2021? Tell us down in the comments below. And don't forget to like, subscribe, and hit the bell icon. Thank you for joining. This was episode 3 of Think Out Louder.